Hello everyone, welcome to the next episode of a reconciliation loan syndications. So here we discuss about today about the cost of carry, how it get calculated and how it is important to know while doing day-to-day work in our organization or any company. So you get this term many times, but we just take the amount and just process at our reconciliation application, but sometimes it is very difficult to calculate or some difficult to know about the term. So here we come with a very simple example to understand you how the thing is work on the cost of carry. The cost of carry is just like a cost associated with carrying the value of your investment. Okay, so it estimate the fair value of your future contract by considering the cost of benefit of holding an asset over the period of time. So when if your guys are preparing for the interviews or something, so this definition is very important to note down. So you can note down this definition as well, and you can also explain this formula that we have mentioned here. The future price is equal to spot price plus cost of carry, or cost of carry is equal to future price minus spot. So how this theory work on the practical we have discussed into this session. Okay, so it is applicable to the storage, dividend, interest rate and insurance. Okay, so just want to give one example how it relates. So for example, you are the farmer, for some you are cultivate the wheat in your farm area, and you have a wheat of 10 lakh rupees at your uh, you cultivate around 10 lakh rupees of wheat. So in this way, when you cultivate and you want some place to store that 10 lakh rupees wheat, so you go to the warehouse. So warehouse charge around 10,000 rupees per month for this. They also charge the electricity bill, and then you transport to your farm area to the warehouses, to transport cost, maybe any cost. So in 10 lakh rupees wheat you want to deposit, just deposit for 1 month, you got a cost of around 50,000. For example, you got a cost of 50,000. So that 50,000 is a cost of carrying that product into for 1 month. It is just a term I am explaining you in the short. Okay, so why it is important at a fund level, or we can say investment banking level, or we can say the reconciliation level, or at a future perspective I am telling, because if 10 lakh rupees wheat you have and 50,000 you are spending, the wheat value goes to the around 10 lakh 50,000, and then whatever the profit you get, profit you will get above 10 lakh 50,000. So if you calculate this cost of carry is something like uh, on this basis. Okay, so here we mention also as a is helps to calculate the future price of financial asset. So here is a example we have taken from the live prospective basis. Okay, so the person A and person B is there. So there is a lender and one is the borrower again, and person A is any bank you can take, and borrower is a hedge fund and mutual fund group. Okay, so they taken 10 lakh rupees as a 10 lakh rupees as a to run their mutual fund. So whatever the cost of this, so they want to pay that cost also, like they want to give the lender the interest also. Okay, they want to give the admin fee, legal fee also, whatever the document they have prepared between them as legal document, but they have to give the legal fees and the admin fee as well. They want to give the opportunity cost, they want to give the distribution cost, or many more. So we can say the cost of carrying this amount between lender and borrower is is called a cost of carry. So here if we total this, we got a calculation of 75,000 is the cost of carry amount. So whatever B get that amount, so he get amount of 10 lakh rupees, but that carrying that amount with him for certain period, maybe 1 month or maybe 1 year or anything, there is a contract. So it is 10 lakh 75,000. So borrower get profit above 10 lakh 75,000. So how it get a profit will explain into the, if you see the column G. So column the hedge fund group or the uh, mutual fund group invest into the many product like maybe stock, bond, MBS, ABS, money market and swap. So their portfolio manager or their fund manager has done some research and they invest into the some product. So the amount is decided into their risks and rewards. So they invested 2 lakh, 2 lakh, 2 lakh, 2 lakh, 1 lakh and 1 lakh, and then they got a return at the end of a month or year 1 lakh 20, 1 lakh 20. We take hypothetical example, this is a 1 month scenario. So in 1 month scenario, the 75,000 is cost of carry, but they invested 10 lakh and they get a return of a 1 lakh 24,000 as a future price. So if we correlate this with our formula, so 1 lakh 24,000 is a future price, the spot price is 10 lakh rupees plus cost of carry is 75,000. So whatever the profit they are getting after reducing this 75 into 25, so whatever the profit, like around it came around 49,000 if you calculate this. So 49,000 is the profit for that. So this term is important when you are doing the investment. So whatever the cost of carry and above that they are getting, so it's called a profit. So here 49,000 is a profit from them. So this is how the cost of carry get calculated. So the amount we have taken very low because to understand the example, but this is in the millions or crore or according to the currency. But hopefully you understand this term as an interview perspective, as said, because we added some definition as well, formula as well to understand you. So hopefully like this detail about the cost of carry. Please continue to like and subscribe this channel to hopefully you get a future perspective about how because we discuss about the many terms in the future video. So thank you so much for watching this video and we'll meet in the next video. Thank you so much.